We've all heard the hype, right? That artificial intelligence is going to completely revolutionize finance, creating these unstoppable money-printing machines. But what if I told you that most of these multi-million-dollar projects are actually doomed from the very start? Today, we're going to crack open the groundbreaking work of Lopez de Prado to understand exactly why that is, and to see what the real solution looks like. Let's get right into it. You know, this quote from way back in 1692, it just perfectly captures the spirit of quantitative finance. For centuries, the absolute smartest minds have been trying to replace gut feelings with hard math, to find a candle in the dark in these chaotic markets. I mean, that's the whole game, right? But here's the real puzzle. We have more math, more data, and more computing power than at any point in human history. So why, according to industry experts like Lopez de Prado, do the vast majority of machine learning projects in finance fail to make a single dollar in actual profit? What's going on here?
Well, the answer starts with a really fundamental flaw in how the research is even done. It's a concept he calls the Sisyphus problem.
Okay, imagine the smartest PhDs in the world, each locked in their own room. Each one is trying to discover some market-beating strategy. That's their personal rock. They push and they push, but because they're working all alone, chasing these aimless, intuition-led ideas, the rock just rolls right back down the hill, again and again and again. That, right there, is the Sisyphus paradigm.
And look, this isn't an accident. It's actually built into the traditional structure of finance, which rewards the Lone Star portfolio manager. Secrecy is valued way more than collaboration, so nobody ever learns from anyone else's mistakes. And the result? Just a ton of wasted effort and a whole lot of rocks rolling downhill.
So, okay, how does this Sisyphus problem lead to failure in the real world? Let's break down the specific reasons these brilliant quants, these quantitative analysts, so often end up failing.
Now, what's really interesting about this is how it just demolishes a sacred cow of finance, the backtest. Quants will run millions, even billions of simulations to find a strategy that would have worked in the past. But Lopez de Prado's point is, this is just finding a lottery ticket that already won. It tells you absolutely nothing about the next draw.
This kind of thinking leads to three core sins. First, you've got the silo mentality we just talked about. Second, the backtest illusion, mistaking that lucky past for some kind of future skill. And third, and this one is so critical, mistaken identity, treating the messy interconnected data of finance as if it's some clean, simple problem from a textbook.
And I absolutely love this quote because it gets right to the heart of the data problem. The easy, clean data, everybody has that. The real edge often comes from alternative data. We're talking satellite images, shipping manifests, web searches, data that's so messy and so difficult to work with that it makes your data team absolutely miserable. That's usually where the real predictive signal is hiding.
Okay, so if the old way is totally broken, what's the solution?
Well, it's a complete paradigm shift that he calls the production line.
Think about gold mining for a second. Back in the 16th century, you had Spanish conquistadors, these lone geniuses looking for giant nuggets. And yeah, they got lucky sometimes, but modern mining, it's a massive industrial process. It uses collaborative teams to systematically extract microscopic gold particles from tons and tons of earth, and it produces vastly more gold. Finance needs to make that exact same shift.
This is what he calls the meta-strategy paradigm. It's about stopping the treatment of strategy discovery as a lone genius's art form and turning it into a science. It's a collaborative, evidence-based production line, and it's inspired by how massive scientific projects like the US National Labs achieve their breakthroughs.
So what does this actually look like? Well, it's basically an assembly line for alpha. You've got specialists at every single stage. The data curators, they clean the raw inputs. The feature analysts, they find the signals. Strategists build the models. Backtesters rigorously stress test everything. And then a deployment team integrates the final product. Every person is a specialist in one collaborative process.
So the shift is just crystal clear, right? We move from siloed individuals to collaborative teams. We go from intuition-based hunches to evidence-based science. And we leave behind aimless rock pushing for a systematic production line that actually builds on itself. Now, this new factory approach, it doesn't just change the process, it actually lets you build entirely new, smarter tools that are made specifically for the unique challenges of finance.
So what does that really mean in practice? Like, what kind of specialized tools can a financial factory actually build that a lone researcher just can't?
Okay, here's a fantastic example.
The old way of labeling data for an AI is to ask a super rigid question, like, what will the price be in exactly 10 days? The new way, the triple barrier method, is way more dynamic. It asks, which barrier will the price hit first? A profit-taking target, a stop loss, or some time limit? It actually reflects real-world trading logic.
Or how about this one, meta-labeling, which is a really clever approach. You might have a simple model that gives you a buy or a sell signal, but instead of just trusting it blindly, you build a second machine learning model on top of it. Its only job is to decide how much to bet on that first model's signal, or maybe whether to just pass on the trade entirely. It separates the signal from the sizing.
What's so powerful about all this is that these new tools are designed specifically to handle the particular weirdness of financial markets. For instance, in finance, your data points are not independent. A 10-day return that starts today overlaps with a 10-day return that starts tomorrow. Standard ML models, they just completely ignore this, and that's where things go so wrong.
So a tool like sample uniqueness comes in and fixes that problem directly. It intelligently weighs each data point based on how much new, non-overlapping information it's actually providing. This keeps the model from getting way overconfident by just learning the same thing over and over again.
So, let's pull all of this together. What does this really mean for the future of finance?
You know, the really big takeaway here isn't about finding some magical new algorithm and just throwing it at the market. The real revolution, it's a fundamental shift in philosophy, from lone artistry to collaborative science.
And this analogy really puts the whole problem into perfect perspective. In science, you had Kepler, who spent decades just painstakingly collecting and describing planetary data. It was only after all that hard work that Newton could come along and develop a grand, unifying theory of gravity. Lopez de Prado argues finance is still waiting for its Keplers. The team's doing the really hard foundational work of just describing the data correctly. Without that, there can be no Newton.
So it really leaves us with this one big question, doesn't it? Maybe the quest to find the next market-beating strategy isn't about searching for some lone genius with a magic formula, but about meticulously designing and building the right factory.